Oh, Hilton, stay. Your beds are soft and cozy. No lumpy couch, no stiff futon, no shower line at crack of dawn. Oh, Hilton, stay. A holiday you're saving.
When you want holiday comfort you can count on, it matters where you stay. This season, enjoy spacious, comfortable rooms and friendly service when you book with Hilton instead. Hilton for the stay.
Here's my 30-second story with Guinness. As soon as my sister and I get home for the holidays, we don't even unpack. We head straight to our pub. The bartender already knows our order, Guinness and fries. We laugh all night, catch up with old friends, and walk home with faces sore from smiling. It's one of my favorite nights of the year. That was my 30-second story with Guinness.
Guinness Draft Stout. Please enjoy responsibly. Imported by Diageo Beer Company, USA, New York, New York.
Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started.
Hi, on today's episode, I'm going to continue talking about all of our value investing topics, but today we're going to talk about position sizing, which will basically be how we can maximize returns through the strategic allocation of our assets. So here, we're already moving on from kind of identifying those mispriced stock securities to the equally, if not more important part, which is how much capital should you put in these opportunities? Because as an active equity investor, finding these mispriced securities is only one part of the equation. The other, which is often less talked about, but it's incredibly powerful, is how much money are you going to put into each one of these ones, because you want to maximize for long-term value creation, and therefore you should consider what is called position sizing. And here is basically how many eggs are you going to put in that bag. So it's astonishing a little bit that as investors, you dedicate countless of hours to do financial modeling, doing all of this annual reports, industry analysis, interview management, and creating all of this DCF models. Yet, when it comes to putting your money to work, determining the size of the investment, many investors are going to rely on gut instinct, arbitrary rules, or just simply default to equal weighting, which is why very few truly understand how to size investments optimally in order to maximize for long-term wealth. So there are some important factors that make this very critical, and one of them is going to be the hit rate that you have as an investor versus the returns that you want, because it is not how often you're right, but how much you make when you truly are right. And think about the average professional fundamental analyst. Despite all of the sophisticated tools and deep dives, academic studies show that skilled fundamental analysts will typically have a hit rate, which means the frequency of being right on a stock pick, in the 52 to 54% range. So let that sink in. This is someone who's doing it as a full-time job and is dedicating hours and hours, probably around 80 hours per week for doing this. And it's only 50% hit rate. So if you bought every stock blindly, you'd be right about half of the time. This tiny difference, that 2 to 4% edge, is going to underscore this profound truth, and is that successful fundamental investors must rely heavily on position sizing in order to drive their returns, not only on being right more often than not. So it's not about how many times you pick a winner, it's about how much money you make when you're in the right versus how much you lose when you're in the wrong. And so if you're right 52% of the time, but your winners are in tiny positions and your losers were huge, technically you'll still underperform. So this is why hit rate versus the actual returns are going to be one of the critical reasons why you have to learn about position sizing. Another one is about what everyone keeps suggesting in investments, and it's diversification. And so this is probably one of the most endurable debates or like advices I would say that I've heard in investments, because many people say that you should have diversification because it's the only free lunch in investing, as some put it, or just if you have a simple idea, basically, if you hold many different assets, you will reduce your overall portfolio risk without sacrificing some expected returns. And this approach is going to be absolutely ideal if your primary goal is to get broad market exposure, often referred to as beta. And also, it's incredibly useful to diversify when you want to preserve your wealth. But for the average investor who wants to grow, let's say like Warren Buffett doesn't like diversification as much because, like, right now he is interested in preserving wealth, but when he was growing, he wanted to have a very concentrated portfolio on the winners to only make money out of the winners. He didn't want to have a lot of options. And Buffett's famous quotes are going to resonate with some value investors because he says, diversification may preserve wealth, but concentration builds wealth. And there are others like diversification is protection against ignorance. It makes little sense if you know what you're doing. So, well, we already have his words. He knows what he's doing because he's doing this thorough analysis over and over and over again for hours and months. But if you just want a normal market exposure, then diversification would be better for you. And basically, the resolution of this debate is going to lie on your own objective as an investor and on your own skills. Because if you're looking to generate alpha, which means returns above the broad market, then you need to concentrate your portfolio. Because alpha, by definition, comes from having unique insights that will differ from the market. If you're spreading your capital among too many holdings, the impact of your best ideas is going to get diluted and your portfolio will start to look like the market. But if you just want to preserve your portfolio and avoid losses, then of course, diversification would be better. So the key here is going to be knowing which camp you will fall into. But I'm assuming that if you're learning about value investing, you want to be those that are building wealth, not just preserving it. So that's why position sizing is going to be important. There are going to be some common methods for position sizing, but there are some that are highly subjective, but there are others that are very quantitative. So there is one first approach that is very subjective, and this is perhaps the most common approach, particularly among the less experienced investors and those who believe in their gut instinct. And basically it is, you will decide a position's weight based on your personal conviction. So if I consider XYZ to be my best idea, maybe it should be 15% of my entire portfolio. And even though conviction is going to be vital, relying purely on subjective feeling without a framework, I think is going to be a bias. One of those that we were discussing earlier in my episodes, like overconfidence. So even though this is the most common one, I think you should avoid it. Second method that starts becoming a little bit more quantitative is going to be equal weighting. And here you simply assign the same weight to all positions in your portfolio. So let's say if you have 20 stocks total, each one will get 5%. And so statistically, this is one of the hardest methods for active managers to consistently beat. Because it's simple, it reduces the cognitive load, and it implicitly means that you're not trying to guess which of your ideas is going to be the best. You just know that you have good ideas.
When the holidays start to feel a bit repetitive, reach for a Sprite Winter Spiced Cranberry and put your twist on tradition. A bold cranberry and winter spice flavor fusion, Sprite Winter Spiced Cranberry is a refreshing way to shake things up this sipping season. And only for a limited time. Sprite, obey your thirst.
The Who's Down in Who Newville were making their list, but some didn't know Walmart has the best brands for their gifts.
What about toys? Do they have brands kids have been wanting all year?
Yep, Barbie, Tony's, and Lego. Gifts that will make them all cheer.
Do you mean they have all the brands I adore?
They have Nintendo, Nespresso, Apple, and more.
What about...
So the Who answered questions from friends till they were blue. Each one listened and shouted, from Walmart? Who knew? Shop gifts from top brands for everyone on your list in the Walmart app.
Then you could also opt for maximum risks. And this is a common practice in professional money management, so maybe it might not be the best one for listeners, but it's often driven by risk management and compliance. So it's going to involve limiting individual positions based on a predefined risk threshold. So let's say no position greater than 10% of the portfolio's total value. And this approach is going to aim to prevent catastrophic losses from a single bad bet. So it will prioritize the downside protection. In the other one, it was all the same. Here, you're going to do it based on risk management. Then there's also another fourth method that's called the mean variance optimizing. And this one is a primary method for quantitative investors. It's going to involve ranking the positions based on an expected return relative to the expected volatility. And while mathematically elegant, its reliance on historical volatility as a measure of future risk and the instability of correlation makes it personally less applicable for long-term fundamental value investors. So this one, even though it's done, I wouldn't recommend it 100% because mean variance is going to be based on historical volatility. Now, there's another method called conviction-based, and this one is evolving a little bit more because it includes as an uncertainty that is result, and the underlying thesis is going to be validated or invalidated. So you may start with a small position, and as you learn more about the company, then you might increase it as your conviction grows stronger and your edge becomes clearer. Or if conversely new information shows up that weakens your thesis, then you would reduce this position. So this is just like trying out and testing to see how much money you should put. And then there are the last two that I think are probably the best. One of them is ranking because some investors are going to create like a scorecard that has both qualitative and quantitative factors. So let's say also including the moat strength, the valuation attractiveness, the management quality, the balance sheet health, stuff like that. And then they're going to use this scorecard to rank securities in their portfolio and allocate the capital accordingly, with the higher ranked stocks receiving larger weights. So this one is very analytical, let's say. So for all of the quant people out there, I think this would be your approach in order to like try to include all of the factors. And then there's a heuristic that's called writing your winners. And it is very biased, I have to say, but it's particularly among hedge fund traders and momentum investors. Because the idea is simple. If a position is performing well, don't reduce it or add to it, just let it run. And conversely, just cut loosened positions quickly before they do more damage. And this sounds intuitively appealing and it's something that's commonly done. I personally don't think that this is useful, but it will directly challenge some of the value investing things that we have been considering because, again, we consider companies for the long term. But I'm putting it out there because it's very popular. Many people do it. My personal favorite would be the ranking, creating a scorecard, because this avoids all of the possible biases and heuristics out there. And so if I had to tell you which of this ones should you use, I'm going to go back to the value investing principles because long-term value investors fundamentally do not view volatility as the appropriate measure of risk. For us, risk is going to be more accurately defined as a permanent loss of capital, which is an impairment to the underlying earnings power of a company. So a stock price that is temporarily falling by 30% due to market fear isn't necessarily risky if the business fundamentals remain intact. The real risk is investing in a business that fundamentally deteriorates, leading to a permanent decline in its value. So in order to create a more robust position sizing framework that aligns with the definition of risk, investors have used a concept that has intrigued and challenged some people, and it's called the Kelly Criterion. And this one was a new concept that arose for me, but I'm going to try to explain it in the simplest way possible because it is, of course, the suggested framework for strategic allocation. So the Kelly Criterion is a formula that was originally created by John Kelly Jr. at Bell Labs because he was sizing individual bets in scenarios like blackjack or horse racing. It provided a theoretical optimal percentage of your bankroll to wager on each bet and to maximize the long-run growth rate of your capital. And even though this was for bets and not for investing, it has an application to investing that offers some insights. The correct derivation of the Kelly percentage is going to account for the magnitude of the potential profits and losses with this formula that I'll share on my screen. W is going to be the win probability, which is the probability of your investment thesis being correct and the stock going up. Then B is going to be the profit in the event of a win, so your expected return if you're right expressed as a decimal, so let's say 0.5 for a 50% gain. And A is going to be the potential loss, so your expected potential loss if you're wrong, and again it's going to be expressed like a decimal, so if I say 0.2, it's going to be a 20% loss. You might encounter a simpler but deeply flawed version of the Kelly formula that will look different because it only considers the ratio of profit to loss, but not the actual magnitudes. So that's why the equation that you should use is the first one that I was sharing, which is here, and I'll leave this one on the screen while I'm talking, the correct one. But the basic idea behind the Kelly Criterion is incredibly powerful. It will tell you the size investments with the greatest probability of success, the largest, but crucially, not so large that you risk bankruptcy. It will emphasize that in any probabilistic endeavor, staying alive, which means avoiding catastrophic downsides, is going to be key to playing the game repeatedly and ultimately to winning the game in the long run. If you bet too much and you lose, you would be out of the game because technically you would lose your money. So that's why here it's going to be important, because this Kelly formula is going to be a way of interpreting this margin of safety. And if you want to learn more about margin of safety, there's an entire book that's dedicated to margin of safety. I'm also going to be sharing the title over here. But what I was telling you is that margin of safety is going to be your cushion, because you may think that you have an edge, but it might be incorrect. So what you want to have is a strong margin of safety. So in case you're incorrect, it's not as bad. So as you can see, successfully identifying the mispriced securities is only going to be the first step. But it is also fundamental to decide how much money you're going to put in it, or as investors call it, position sizing. As an active equity investor, I want you to generate true alpha and to maximize the long-term wealth. And this is going to depend on how strategically you will allocate your capital across your opportunities. I already gave you many options like the scorecard or the Kelly Criterion, or even subjective ones like investing with your gut, and the others that I didn't recommend, like cutting on losers and getting more winners. But I think all of these ones will have to be eventually combined in order to get to your margin of safety. Again, if you want more information, you can read about the margin of safety, but with this, basically you will already have all you need to be a value investor. So, what comes next? In my next episode and final episode around value investing, I'll create a checklist so you as an investor already know exactly what you should do, what you should prioritize, and how you can start creating this checklist for your own so you avoid biases and you can start building your own wealth. If you like this episode, share it with a friend who also wants to learn about investment, and tell me in the comments if you liked it and if you learned something interesting. Give me a review as well, because this will help me tremendously to reach more people globally. And stay tuned so I can see you next week and we can wrap together this episode around value investing.